Hi, I'm Sarah Lacey, and welcome to Venture Underground, the podcast that takes you inside what is really happening in the venture world, the good stuff, the gossip, the tips, the tricks, whether or not we're in a bubble, whether or not you should be part of the bubble. I am joined, as always, by my co host, Dessel, co founder and CEO at Deo Resi. And this week, we are talking about deal flow. Now, I know some of you are like, wait a minute, aren't we talking about like raising a fund? How are we doing deals already? But if you are an emerging manager, if you are starting to even think about raising a fund now, you need to be thinking about deal flow already. Tell us why. You don't have the luxury of just thinking about raising money, right?
Yeah, most funds actually get raised on the back of great deal flow. We were talking today with a bunch of managers in the cohort, and someone's like, hey, if I tell them my thesis and people aren't excited, can I, come back to them and da da da? And it's like, listen, if you have a great thesis, it indicates that you have access to great deal flow. And if you have access to great deal flow, that gets investors really excited. So everyone's like, I don't know, man. I don't think that's true. So I actually tested it in real time this morning. And I said, okay, this is a true statement. And I'm going to test how fast you can react. Uh, so this is all I'm going to say about what I'm doing, and I want to see how many people are interested in investing. And if you do it really fast, I'll consider letting you in. So I'm best friends with Elon Musk. I get in friends and family rounds to his companies. Would you like to invest? And people are like, yes, 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 yes. They're like, it's like, and I think literally everyone wrote, someone made a joke along the way. No, I want to see a more detailed thesis first. But or I want to see your deck. I want to see your deck before I decide. It's like I can get you friends and family round access to Elon Musk's next companies. Do you want in? Everyone's like, absolutely. So your thesis could be in fact that simple, and get tons of people immediately interested to invest without seeing a deck, without knowing anything more about anything. And so that's why deal flow is important, because if you have a proprietary, very interesting source of deal flow, and you get that in front of the right investor, they are going to want to invest in your fund, full stop. So, to tell a story about that, another one, that was an anecdotal story, though it's true, but that was just an anecdote to see what would happen. Of course, all these skeptical people were all of a sudden like, please let me in. Um, but we have a fund in our portfolio that is a sister fund or connected fund to the Stanford Blockchain Accelerator. So it's the Stanford University run accelerator for blockchain companies coming out of the college students, both grad students and undergrad. And the reality is that they're minting billion-dollar companies. And the funny thing is the fund has major brand name venture capital firms investing in it for the deal flow. And, they have no problem getting LPs. Their next fund is going to be ridiculously large. And it's just, because they have this proprietary, very interesting source of deal flow that happens to be minting billion-dollar blockchain companies. So deal flow is critical.
It's so interesting. I've been working on talking to a lot of LPs and doing case studies on LPs investing in these funds. And that one actually came up today in a case study I was doing with an LP. And they were saying, basically, before investing in some of the Go VC Lab funds, they only invested in managers who were experienced managers who were on fund 2, 3, and 4. Never would ever consider investing in a brand new manager. And they actually cited that one as an example of one they invested in. And I said, well, what swayed you? And they said they have proprietary deal flow. It was literally what they said. And so I said, when you decide to invest in a new manager that doesn't have a track record, Why? And they said, well, they're almost all VC lab companies, and they're all because they can make the case of proprietary deal flow.
It matters a lot. I mean, look, there's so many things to talk about here. There are other tricks and tactics you can do. You have what we call pipeline deals, which are deals that, because of your sourcing capabilities, you're going to bring into the fund. And you say, look, I have this amazing network to get deals. And as a result, here are the first three deals I plan to do. They are my pipeline deals. And they can be very exciting deals. Like, so and so is a top researcher at this big university and came up with this, you know, new way of doing cold fusion, and it works, and he or she is breaking out, and we are going to be the angel and or the pre-seed investor in that deal. It's like, whoa, functioning cold fusion, I'm in, right? So that type of pipeline deals get people very excited. But there's another thing that you can do, which are called warehouse deals, which is that you, as an investor, maybe made an angel investment in a company. That company might have done really well. It could be 5x, 10x where you invested. And you transfer that warehouse deal into the fund and say, hey, dear LP, because you're backing me, I'm giving you this 10x deal out of the gate for free. And what I mean by that, for free, is whenever you warehouse a deal, you transfer it in at whatever valuation you invested in. So let's say you put $25,000 in, and now it's 10x, so it's worth 250,000, right? So you put it in as though it's $25,000, and all the LPs coming in will see $225,000 of instant gain. That's another very good tactic for you to not only talk about your deal flow, but to demonstrate it. So you can demonstrate it with a pipeline, and you can demonstrate it with a warehouse.
There's also, of course, past deals. Like if you have a track record as an angel investor, that's something you can talk about. So there's sort of these categories of either deals you have, a deal you might be about to close. So that's kind of like what you've got so far. How do you then show them, demonstrate what you'll be able to do? Tell us about deal pathways.
They're archetype deals that you want to do. So you're going to say to LP, hey, I want to do pre-seed AI deals from the hot Silicon Valley engineers that are breaking out to start their new companies. Okay. That's a pretty interesting set of deal flow, right? If you can get the top AI engineers breaking out to start their own companies, honestly, um, that's a gold mine. You can make billions very quickly. So
I mean, the markups alone will be amazing, which we'll talk about that in a second. But
yeah, so that's the archetype deal that I'm going after. And then you have to explain why you can do that, because I myself was, let's say, was one of those engineers, and now I want to become a fund manager to fund my friends. That's very credible. Okay. But then it's like, to your point, Sarah, what are the pathways? How? Like, where are they coming from? Like, you're going to be speed dialing these people? Are you part of some community? You have to think about, like, what is the pathway? Obviously, if you have a proven network, like you were one of those AI engineers. You went to school with a bunch of the top AI engineers. You worked at the large companies with those AI engineers. Then it's pretty believable that you have a deal pathway to get more of the AI engineers. But you could run an accelerator, right, as a deal pathway and have great access to deal flow. You could be a teacher at a major university on AI. You could have a partnership like the blockchain builders fund that we were talking about that is connected to a university or a university program. So I would say, like, I have a list here. Like, one is you could just say, hey, look, I'm really good at research, and I can find deals that aren't really on the market. So you go and find them, right? A second very common deal pathway is because of who I am and who I know, people refer me deals all day long. I am the AI whisperer or the deep tech whisperer. Like we have one guy, speaking of which, he's actually the mad scientist whisperer. All these mad scientists working on crazy problems come to him for advice. And then he's like, "Wow, that's a really cool idea. You're gonna boil water and turn it into, I don't know, like a dragon." And it's like, I'll back that. So really crazy ideas. Um, that as part of that referral thing, you can have a brand. You could be a famous author. You could be a lot of we work with a lot of athletes. We work with a lot of famous executives. We work with a lot of people that have like we work with top influencers. And a lot of them realize, wow, I have this massive audience. I'm getting a lot of interesting deals. I should do a fund. And then I would say the last big bucket, and we kind of talked about this, is like just stuff that you do. Like I'm a top scientist, I'm a top researcher, I'm a top reporter, I'm a top. So you're actively doing stuff. I run a large community of these people. So you're actively doing things. So again, research, referrals, branding, and activity are the four major buckets that you usually see these pathways come through.
Do you have to have a pathway? Like, those all sound like really special things that not everyone has.
There are lots of funds, and their only thing is I invest in YC companies. And their pathway is I show up to demo day. Now, as you and I know, because we interviewed some of these people on stage, it's much more complicated than that. To be a good YC investor, you got to get in before demo day. So there's a lot of gamesmanship about how you come in before demo day and get top ranking with the different startups that you're backing so that you can get the best deal flow. So it's not quite that simple, but there are simple deal pathways. They're less attractive to LPs if you're just like, hey, my superpower is I can attend 5 demo days in an afternoon. It's like, maybe that's a
Right. And
superpower,
it's
but
like, at the end of the day, you're offering people money. There's a lot of people offering people money. There's a lot of people who've been doing it with a longer track record, who have a bigger brand. And so you're going to have something that's going to set you apart. So if it's not going to be a pathway, it better be something else.
something special. Like I know more about quantum mechanics than most because I've been a quantum engineer for the last 20 years, making me one of the OGs. And so when I see a quantum company, I know if it's real or not. In fact, that was a great example. We had the other day, I met with a fund doing very well. They had a 4 for 4 hit rate in fund one. All four look like they're going to be big fund returners, right? Which is kind of unheard of. And they're just the old school people in the industry that know everybody. So that's their everything. That's their deal pathways. They're unique. They like, hey, we've been in the industry 30, 40 years. We know all about it. It's a very nuanced niche industry. We know all the players. We know if it will work or not. We can and so it can work, right? It's not very differentiated, except there are maybe you're one of a few people that are in that position, right? And ultimately, Sarah, what you need to find through this whole process are what we call rock stars.
But aren't you supposed to be the rock star as the fund manager? Like,
Ah,
so are you starting a band? I'm sorry, I'm the rock star. I'm the fund manager.
well, we like to say the manager is the prize, but their goal is to find the rock star. So what is a rock star, and why do they matter, particularly in like let's say fund one or fund two? So um, you can't take what might be considered classically risky bets when you're working on fund one and fund two. And that doesn't mean you can't do non-consensus deals, But you got to make so when you're scouting rock stars for fund 1 and fund 2, the first thing is they have to match your thesis exactly. So if you're saying you're going to do pre-seed deals and all of a sudden you have 3 or 4 seed deals, then your LPs are like, "Hey, wait, you told me you're going to invest in pre-seed deals. I'm giving you money and now you're not going to invest in pre-seed deals, you're invest in seed deals. What's going on here?" And you're going to have to explain that's not good. So you want to do if you're doing a pre-seed fund investing in AI companies, you better invest in pre-seed AI companies, right? Um, but there's another wrinkle, right? That's to be expected to some extent, but there's another kind of more important thing. You've got to find companies that are going to get marked up, that are going to get a valuation increase very quickly. And there's a few hacks to do that, but that's your job in fund 1 and fund 2 because you're raising and you got to prove yourself. And the best way to prove yourself is to have companies you invested in that are marked up. And if you don't have that, what happens is you have what's called a J curve. And what that is that when you're investing in companies and they don't have valuation increases, so they stay the same, but you're taking fees, management fees, fund expenses, and things like that. So I'm an LP. I put $1 in. You invest most of that dollar into companies that the companies stay the same, but maybe you take 20 or 25% out for fees. So now you don't have a 1x, you have a 0.75x. You go down. So it's very common in the first 3 years of a fund for your returns to be negative. It's called the J curve. But you as a new manager, you don't want that. You want your returns to be positive. So you want to find companies that are going to get marked up very, very quickly within 3 months, within 6 months, 9 months at the most. And there's some tricks to doing that.
So this is interesting. And I was talking to one of our funds that ended up doing a start fund because of this, because they were talking to LPs and the LPs were saying, we're pissed. Basically, the LPs were like, look, we put all this money in startups for the last few years and we are getting nothing back. We are getting no liquidity. We have been promised, and like nothing is exiting. And like we don't believe anyone anymore. And so they were kind of like but the reason they were getting these LPs over the finish line is they had a handful of really, really good pipeline deals. And so they were kind of like tempted, but they were basically like, okay, look, if we are going to get these guys over, we are going to have to our first like 6, 7 deals. Know there's going to be quick wins. And we have to organize this whole thing for quick wins. But the ones they could get into, they knew would be quick wins, were closing immediately. So they had to do a start fund where they knew they could like close the money quicker than a VC lab one so they could get in those deals that were closing immediately because the eyes on the prize was I need a quick win to convince these LPs because then those LPs will come in because all they were hearing from LPs was we have been sold a bill of goods again and again and again and we don't believe we'll ever see liquidity.
There are lots of quick wins out there.
I was gonna
Yeah.
say, it goes back to what you were saying in the last, podcast, which is how this is a different game than running a startup. You're a money manager and you've gotta listen, and, like, what these fund managers were doing really well is they were listening and having a dialogue.
Yeah. And look, quick wins are out there. I promise you, if you're diligent in your archetype investment and working on deal pathways, and you have to be patient because you may not see one right away. It may take you a month or two to find a quote unquote quick win, which we call rock stars. Uh, but when you find them, you better move, right? So I can give a classic hack, if you will, to find a rock star. So if you're a good money manager, right? If you're a good VC, ideally you're befriending and helping entrepreneurs all the time. Even if you're not expecting to invest, you just want to be help, 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 and then hope to get in the round. Now, if you've helped an entrepreneur a lot, you can come in after the round closes, not forever after, but like rounds close. And occasionally they let people in late. I've done it. I think every entrepreneur has done it. If you really like someone and you're like, you're amazing, you've helped me
Especially if
so
it's not a big
much.
check. Again, advantage of a small fund.
Yeah. Yeah, if it's a big check, it messes everything up. The cat, everything you gotta, it's a mess. I don't, but if it's a small check, of course, like, come on in. So what happens is, so okay, you find an entrepreneur, you're helping them. It's like, oh, this is going to be a winning deal. Let me quickly close my fund. Let me come in. And you might come in, let's say 2 months after they do the final close, whatever. We're closed. We're not taking any more money. Listen, I love the company. Hopefully I've been of help. Could you let me in? And they say, okay, I'll let you in. Now, the first money in that round may have come in 5 months ago or even 6 months ago. You'll probably be the last money in, and you'll be 5 or 6 months later. What does that mean? You're 5 or 6 months closer to the next round than the first one that came in, which means the markup for you might be 6 months away or 9 months away, where for the first person, it's 12, maybe 18 months away, right? So there's a real advantage to coming in late. It's a hack. You can't always do it, right? I certainly don't recommend like that being your exclusive strategy. But to be fair, most of the time why this happens is you don't have your fund yet. So you say, "Oh, I have enough interest from LPs." You go back to the founder, you'd be like, "Oh, I just got the interest from LPs. I mean, this happens all the time. I'm pulling the round together. I'm sorry I'm a bit late. Can I come in?" And they'll 9 times out of 10, the founder will say yes.
Another thing on that is what gets an LP over the hurdle to back a first time founder is, or even a founder that's on their second fund, but like it's, a quick second and they don't have a lot of track record. They want to know specifically what the value add is. So even if you don't have markups yet, even if you don't have exits yet, they want to know like what they want to talk to founders and like, what's the case study? What did you do? What specifically did you do? So I think like in those cases, if you're getting into those deals last minute, you have done something extraordinary to help a founder, and so you've earned your way in, and it's gonna be a great story for when you're bringing in more LPs.
And honestly, that's the narrative of this whole industry. You're seeing a new class of manager come out, and they're give first, help first, add value first, and invest second, and also then continue to add value after they invest, and be basically on call for as long as the founder that they're backing needs. And I think that's really a beautiful thing. And so what you're seeing happening in the world, and this isn't talked about very much, and hopefully we can get this narrative out there more because it's what's happening, is this new class of managers coming in and really helping founders all around the world to build great businesses. Those businesses graduate to the point where they can get invested in by a Sequoia or an Andreessen Horowitz or whatever, because they're like, hey, I've had a lot of help along the way to get to where I am. I've had some great investors. I've had some great people who've advised me. And now I'm ready to go for these bigger pools of capital. And so the reason these big pools of capital exist is because of the small pools of capital that helped all the founders get ready.
Yeah, because Andreessen Horowitz cannot invest in anything that's nascent or normal size. All right, last thing we're gonna cover before moving on from this topic and wrapping up, archetype investments.
I'm going to give kind of two views on this and talk about it over time. So, generally speaking, your thesis is something that you invest in 80% or more of the time. So, it's not 100%. So, if you say I'm doing seed stage AI deals, you can do some pre seed AI deals. You may even do a Series A AI deal. But 80% of the dollars, 80% of the time or more, it's seed AI. Now, when you're starting out, though, it really needs to be in any new fund vehicle, it needs to be 100% because you got to walk the talk for the LPs to prove that you're going to do what you say. And so the old adage in venture capital is tell them what you're going to do what you said you're going to do, and then tell everyone what you did, right? And you need all those things to line up a few times before you've built trust with your limited partners. And then you can start doing things a little off thesis and say, hey, we found this amazing opportunity. I realize it's off thesis, but you've seen what I can do on thesis. This is that good. We're going to break thesis a little bit and do this opportunity. And so your archetype deals are the ones that really are perfectly on thesis and get people really excited.
So when I was an editor, we used to always tell reporters, like, you've got to learn the rules before you earn the right to break the rules. So you're basically saying you've got to earn the trust before you earn the right to break the trust or test the trust.
Exactly.
All right. What's the single biggest mistake you see people make when it comes to deal flow?
I mean, the list is long. So, I mean, the list is very long. The problem is that it's not all the VC's fault, right? This is where it gets a little tricky.
I mean, of
There
course
are
not. It's hard. You're looking for not even a needle in a haystack. You're looking for something that you don't know you're looking for.
Yeah, yeah, and there's charlatans out there. Okay, let's just call it for what it is. There's some entrepreneurs that are BS you. So we have a whole deal review offering that everyone that works with us will review their deals for them for free. And it turns out it's super popular and we catch stuff all the time. Now, there's things that like most of the bad stuff that we catch are things that entrepreneurs did either consciously or unconsciously that can really screw and in a bad way the venture investor. So, examples of which include, and there's really endless numbers, like they'll modify something deep within the safe note uh, that you would never catch unless you do a compare with the stock safe note. And you're like, wait a minute, there's a whole addition of language here. So, like, secretly modifying legal agreements, template legal agreements is look, VCs have done this as well, but these days you see that more done by the founders than by VCs. And that can really result in bad things. Another one that we've seen is like if you're like a LATAM company, you may set up something like what's called a Cayman sandwich, and you'll have a Cayman entity and a US entity and a entity in your home country. And sometimes they don't transfer the equity properly. So if you actually invest, you're investing in nothing. Like there's nothing there. It's like a empty shell. And it's like, wait a minute, there's nothing in the shellco. What's going on? It's supposed to be holding assets. Obviously, then after that, it's like they could say the product's further along than it is. But so I would say there's a certain level of due diligence that's needed that even a good investor can overlook. Like you check the agreements, you check the founder background, blah, blah, but you don't check that the entity has the assets in it, which is kind of assumed, right? Like, so, and a lot of that is just founder stuff, sometimes accidental, sometimes conscious. And so I would say working with someone like us or someone to help you with diligence when you're getting started so that you can know kind of the corners of the room to look in to find the little hidden things is very important.
So when people we've talked before about this like 20%, which like no matter what we do, no matter who comes in, it's always 20% who graduate. So when it comes to deal flow, we've also talked about in the past that people think, you go through this and the hard thing is setting up the fund and then it's raising the money and you hang out your shingle and it's like, I'm a VC, it's all going to pour in. And like, we're kind of talking about it's the opposite. So how many people get into a program like BC Lab or starts raising their start fund, realize really they've got to be bringing the deal flow as the way they're doing this and think, well, shit, I don't have a pathway. I don't have this. This is not for me.
It's hard to tell, but I can answer it a different way, which might get to the same thing. If you find a killer deal, it's like the world opens up for you. It's like the oyster with the pearl, right? So the almost the other way to look at it is, it's not clear. There's lots of reasons that so what we're talking about here is about 1 in 5 managers succeed in launching a fund. And that seems like a strange truism, like Moore's law type truism. And we're not really sure why. But I can tell you that if you look at the bottom 20%, not the 80% that fail, if you have a great deal, like the earth moves, right? It's like, whoa, LPs start coming out of the woodwork, everything. So that, one of the things we encourage someone who's thinking to launch a venture capital firm and fund is, you can do all the reading on the model and this and that, and that's great. And I'm not saying you shouldn't do it, you should do it. But if you really want to be a VC, find a great deal.
You can get lucky. You can find one
Yeah.
hit, basically. I mean, it is a hits-driven business, so that's not a bad
Sarah,
broad.
all these funds, their whole funds are like not even
Look,
whole
you and I
funds.
both know. I was looking at the Midas list the other day, and, like, you and I can probably, without saying names, telepathically articulate the people on the Midas list that it's a shock they're on the Midas. Like, there are people I thought that they would be fired by now because they had not
Oh
done a
yeah,
deal
I
in
know. I
so
know
long.
many of whom you're probably thinking
I
of.
recently looked the other day out of curiosity, and I was like, "What? You?" And it's like that one deal. I mean, that's the industry. That's the
Well,
industry at a grown-up Sandhill Road level.
well, it gets even crazier. It's not just the industry. So in any vintage year, right? The returns of all the funds usually boil down to one company, not like
Yeah.
5. Of course, I'm not saying that there aren't other good companies, but if you look and say, wow, this vintage year, 2010, there was a lot of money made, and it's like, let's say hundreds of billions of dollars. It's like, what's the valuation of Uber? Hundreds of billions of dollars. Oh, it was all Uber, wasn't it? Pretty
I know.
much.
And you know what? When I used to be a journalist covering the space, everyone who was not that company would get so mad or in that space, and they'd be like, "Well, like you always talk about startups and you talk about this, and you're really only talking about this." And it's like, because that's 95% of the money. Because that's 95% of the money right now. And that's why
And
it's
and
such a lopsided ecosystem.
and Uber is a great example. All the backers of Uber, concluding like multiple of whom are very good friends of mine, were total like non-good investors, right? They're not. It wasn't like Sequoia and Andreessen. It was like Jason Calacanis and my friend Steve Russell, and like
People who
and
were in a hot tub with Travis, like they were not like literally, there are people who were in a hot tub with him who became rich. They were not
Or they,
discerning.
yeah. I mean, when you say rich, I mean crazy rich, like tens to hundreds of millions and some of them went insane as a result. But so that's what I mean. Like these deals aren't always super obvious. It's eBay, I remember they came and pitched me, and my partners were like, hard no. And the reason they were hard no is so Piero Madar, who came in and pitched us, he's like, well, so we get the Pez dispenser, we put it on the site, and then people buy it, and and they're like, we're like, how much do they sell these Pez dispensers for? And he's like, $1.25, and they're like, so everyone's head just like blew up a minute, and they're like, wait a minute. So they're mailing a check for $1.25, and then someone's mailing the Pez dispenser for a dollar.
And that was
And
pre-PayPal, so
oh
there's
yeah,
no
yeah.
way to do it. Yeah.
So they put 25 cents on the thing, and he's like, well, and then they're like, what's your fee? And he's like, our fee would be 10 cents. And they were like, so what do you mean? He's like, well, people mail me a 10-cent check. And they're like, what? And I'm like, yeah. So every day I carry 2 big satchels on my back to the bank with checks. And they were like, this is the stupidest business ever. This dude is carrying satchels of checks to the bank every day. And I was like, no, no, no. This is the best business ever. If you like something so much, you will mail a check for less money than the postage and the envelope, and then some dude has to carry. We'll solve that problem. That's a solvable problem. Someone somewhere will solve this problem, and then the company will be huge because they're willing to spend more money to mail the check to make honest and pay the thing. And everybody pass on eBay. And there was one firm that didn't pass on eBay. It was Benchmark. And
And it made
Benchmark,
benchmark.
it made
It
Benchmark.
made benchmark.
So it's like literally, guys, it's one deal. And if you're in the right moment at the right time and you
I mean,
get that
Facebook made
deal,
founders fun.
exactly. If you get that deal, it's like you will be an internet and venture legend.
That is, I don't, they can't think of a better note to end a podcast on. I'm ready to do a start fund right now.
Woo! Anyway, this was lovely, guys. Find that one deal and have a great afternoon, evening, morning, wherever you are.
Yeah, scouting that deal. Now the pressure's on.